Hello, Ryan Garland. I am your host of the Paradyme Shift. I cannot wait to expose the true inner depths of institutional wealth building and how to dig deep into real estate investing. Hey, everybody. Welcome to the Paradyme Shift podcast. I'm going to get right into it today. Joe pulled up some of the latest requests, but probably one of the most popular engagements from people on all of our content. And I'm going to kind of list some of these things out and answer these things to you. But one of them is, why don't we chase trends? We follow the data. Data is massive. You'll hear me say it about it all the time. And I think right now the world's already burning enough, right? We don't want to try to lean on our own understanding. There's things that we're going to miss. To try to be more feeling driven right now, I think is just naive. I think what you need to do before you make any decisions is look at data, look at where the world's going, where spending habits are going, what baby boomers are doing, healthcare, all of the things that the wealth is moving into, right? So if you look at BlackRock, Blackstone, which way are they going to invest their money? Which assets are they investing into more heavy? Those are the things that are really important. So if you're not tracking the data, you're going to make a big mistake in your investment endeavor or journey. The other thing is the trends. The trends are part of that data, right? What's trendy? For example, barn dominiums, steel building methods, everything that happened with fires in LA, State Farm leaving California. I mean, it is just unbelievable of all of the things that are going on that you have to consider, and then going after those trends and understanding why they exist. And then finding out how those things are being built. How is it actually being accomplished? Okay, great. I understand why, but how is it actually being accomplished? For us, we're actually manufacturing a lot of our own buildings right here in Lake Havasu, or at least a lot of the components. And then we'll go to maybe another manufacturer, but we're bringing it all in house so we can kind of control the narrative, control the cost, control our timelines, and mitigate risk. So there's a lot of those things that you have to understand the data, but then why, and then understand that everyone that's going to be a part of that trend actually has the ability to perform as well. So it's not just the data that will kind of give you a spark. It's how is it actually going, and all of the things in between that also have supporting data too, to accomplish what the goal is, right? So you have, you have us kind of looking at things from a different lens, I think more than most, but also very institutionally driven. We're getting third-party market studies. We're using specific groups that all they do is focus on the Southwest as an example, or they have a very good understanding of this area, like an appraiser would, right? Those type of things. Let's see. Why most developers build based on what's hot. I would agree. So I think I tell people this all the time. Builders and developers are just kind of like big kids that like Legos, okay? So they could drive by a property and go, you know what? It would be so cool to build a gas station there, or so cool to build apartments there, or so cool. But that doesn't mean that it's good for the city or it's good for the community, right? So in essence, builders and developers are just gigantic children. So you got to know that. But I think that is the case. Developers by nature like to build stuff they want to build, which is great. I do too. People go, hey, Ryan, why aren't you building more storage? And I'm like, well, storage just isn't sexy. I mean, it's great numbers, great investments, but I just don't really want to do it. I'm at a point in my life where I want to build things that I genuinely like, but if I can keep the same investment strategy and structure as the storage, then that's what we'll do, right? So you kind of have to you got to have to know and understand why developers start a process, and that most of them, 80% of them, are just big kids. But you really have to drill down into the trends in the data. So, okay, how Paradyme uses population growth, rent demand, migration trends, how we look at those. So, rent demand is good when you're building apartments, right? Like what's the migration out there? What's the affordability number look like? What's the job market look like? So when you're looking at rental profiles, if you're building, for example, apartments, that's a different data strategy, right? By nature, rentals for apartments are more lower income overall. So when you look at the average medium income in a city, it's a little bit 25% lower than that is where you want to land in regards to your rents for whatever building or project that you're developing. So kind of keep that's like kind of a metric to follow, right? So there's a lot of those kind of rule of thumbs that you can use to kind of vet projects, but that's one big component as far as rent growth, rent understanding. Let's see, population growth, of course, goes the same way, right? We all know Texas is booming because people are migrating to Texas. We all know certain parts of Tennessee or Florida, right? People are leaving New York, for example. A lot of private equity now that's leaving New York and Chicago. They're all going to Fort Lauderdale. I think there was a publication out there floating around talking about there's more private equity firms in Fort Lauderdale than anywhere else in the country now, because everybody in companies are getting out of New York and again, Chicago. So, those are the things that just happen, and you want to follow that and understand why they made the decisions. And so a lot of that pop growth is money's going to follow as well. So, and mind you, when, like, I'll use Havasu as an example. When people are retiring and they're moving here, they're also moving their money here, right? They're buying their houses, they're going to go get a credit union, for example, accounts. They're going to start banking at maybe a local bank. They start moving their money here. They open up maybe another business or they buy, more real estate here. They just move their wealth here. So when pop growth goes on, more wealth is going to go there, which means more job demand. The list kind of goes on. So you have a much better outlook on making an investment, and obviously depending on what you're trying to create. So that's important. Let's see. I keep scrolling here, so forgive me. Examples of what you do to avoid. Oh, what we do to avoid certain assets. I would say, we were a little bit more diversified and spread out, before the pandemic. We were a lot more involved in more things. I think what you're going to see is that we're kind of honing in our craft more and really starting to become more professionals at like one asset or two asset classes. That's where we want to hover. I think, the business is hard enough. Every project is difficult enough that it really does take a lot of energy and a lot of polish and a lot of hand holding to get anything built and done in today's environment. It's just so different than it was, 10, 15 years ago. So it's really, really important that we stay on that track and stay super focused on that type of development or asset class, and kind of focused as a firm. So one of the reasons why I want to share that with you guys is because most people invest based off of emotion, not necessarily the data. And that's good, right? You want to get the warm and fuzzies about the developer, the development. If you're just a hands-off investor, more of a limited partner, you want to get the warm and fuzzies to make sure that you're, getting into the right group. However, really take a look at our, like our pitch decks as an example. We cite where we're getting the data from that is ultimately helping us make the decisions that we're making and why we're going so far into a specific asset. So, again, because people are more emotional nowadays and because of the volatility, it is important that you really do consider the data as being a kind of your true north on your decision making for your wealth creation or preserving your wealth. Okay, guys, got another one for you. The biggest mistakes new investors make. I think this is really important. Not trying to drive you into a direction. I think these are going to be massive bullet points for consideration as to why people make big mistakes. And to be candid, I get investors all the time that are current investors that have made investments into other syndications that are just having much larger issues than I could have ever expected. And it's because they didn't understand the structure. So chasing returns instead of understanding the structure. That is the most common. As an example, when I have the barn caves, the returns on the barn caves are much higher. So we get a lot more hits on that investment. So regardless of the term, they see 30% plus and they're like, I want to know about that one rather than the 20% plus. People naturally go to where the money's at. So by nature, people are greedier. And so they want to know where I'm going to make the most money. So that is a problem. I think people need to identify and try to understand the structure first to then identify the risk and how real that 30% returns really is, right? Because I'd say other operators and developers, they use those numbers to try to get your attention and then get you in, but they really weren't able to paint the picture and explain the structure, and investors really didn't know what they're getting themselves into from the beginning. So that's a big thing. So you have that chasing returns over understanding the structure, not knowing the operator and the misunderstanding. So again, not knowing what it is that you got yourself into. Timelines, liquidity, waterfalls. That's another thing. A lot of people are looking for cash flow, but they don't think that equity investment opportunities have cash flow components to it, which one of ours does, the other one does not. Meaning you can invest into something where you have a big equity kicker, like a 30% return on the back end, but you get cash flow throughout the process. So you're getting cash flow, each year. So you're getting some income while you wait for that big profit participation on the back end, right? So again, not knowing, okay, I know I need cash flow right now, but I also want to make a bunch of money on the back end. because you need it both. You may need both of it, but you're unable to identify which investments or operators have that. So, that's a big thing too. People want cash flow and people want equity kickers on the back, and they want to build their wealth on top of generating cash flow and putting their money to work. Let's see. Most investors don't lose money because of the market. They lose money because of the decisions. I would agree with that. I would say that most developers, it's not that they're making bad decisions. It's just that they're trying to navigate shifts in the game. And the most important thing you do as a developer is stay on track based on your structure and planning. Where you mitigate the majority of your risk is in planning, design, planning, making sure you have the construction management, make sure you have the right numbers for your line items, where you're going to get your materials, what your lead times are, what your install times are, which how many subs have how much labor, how long it's going to take for them to deliver. Logistics too, right? So it's all kind of comes around the management, and planning is where the majority of the risk is. And as long as you've planned it properly, you've got a track record on how to navigate landmines, and you have a good group of people, you typically would do really well. So that is it for that concept. If any of this segment was of value to you, I encourage you to take a look at some of the other webinars and what it is that we're doing as a firm. I manage a $100 million debt fund now, which is a distressed asset fund. I do a lot of things in private equity, from equity opportunities and development and identifying materials, all the way down to opening up gyms. We just opened up a gym in Lake Havasu. We'd encourage you to take a look at the Family Office Society website, see what type of product that we're bringing to the town, and look how fast we ramped up with memberships and showed proof of concept of way the world is moving, but we use the data to support our decision making with that investment. We'd love to continue to encourage you to watch what it is we're doing and how we're mitigating risk through these unique times. I really appreciate the opportunity to earn your business. And if there's something that you guys want me to touch on or talk about, or topics, feel free to DM right on this post. Let me know what it is you'd like for me to touch on so I can go ahead and give you more value and continue to hit some of the things that matter most. So thank you very much for watching. We'll see you soon.